Excellent. Okay, we are recording. Nice. So if you're not already on our mailing list, you can snap the QR code. I think everybody here is, so you don't have to worry about that, but we send out our top picks every week. And we just sent out a market update yesterday with all of the October numbers and some other exciting things. So you will get that from us. And we'll just go through our usual agenda. So just love to share with each other who's here and talk. Oh, wait. Yeah. Then Bob and I will give quick intros about ourselves. Then we're going to go into commercial investing, and we're really going to cover the financing, ROI, and opportunities within the top 10 questions that Bob gets about commercial real estate investing. So we're going to do that kind of format similar to how we did for the
It was really like top 7, and we were really big at the
I know. So, but if we didn't cover a question you have, then we've certainly got some time. And then just so you know, our next meetup is going to be on Thursday, December 14th. Just to keep us well ahead of the holiday. I haven't settled on a topic yet, so if anybody has ideas, let me know. We did get one request for investing out of state again, so never hurts to talk about that because we're all looking for lower price deals, I think. But yeah, let me know if you have any other ideas. So let's get rolling with who we are, and then we can get into all the juicy stuff. So Summer, you're here first.
Hello, I'm Summer. I'm local to Bend, been here since 90. I am a new investor, ready to make my first deal.
Yeah, and what was on your vision board for next year?
2 doors in 24.
Okay,
Yeah.
2 doors in 24. I like it. Awesome. All right, Cherie.
Hi, everyone. I am from Oregon, but I'm on a trip right now. I'm in Vegas. We're going to watch the Formula One races. Yeah. So anyway, it's really nice here. Hope it is there too. I would say still a newbie investor. I do have 2 homes and 2 in escrow, and this is in Ohio and Illinois. So I'm an out-of-state investor. I do something a little bit different than most of the people in this group. However, I'm still always interested in the different financing programs that are out there. I basically look for private lenders who want to make double-digit income over 5 years. So that's what I pay them, and it's not always easy to find those individuals, but if not, then I go to groups, lending groups. So I'm looking forward to hearing what Bob has to say.
And what was on your vision board for 2024, Cherie?
Oh, well, I think I'm the oldest of everybody in the group, so I'm thinking retirement. And not that anybody else is thinking retirement, but I'm a late bloomer as far as retirement and being self-employed. There's not a whole lot out there for self-employed. So I'm actually, my vision board is just doing my slow flips for the future, and that's what will be my retirement. So it's just going to be one house at a time.
Nice. And you're already up to 4.
I am. I'm hoping to get to 5 by the end of the year. We'll see. But again, this is such a great topic because funding isn't always plentiful. It's not for what I'm doing. And that's what makes it. You got to have money to buy this stuff.
So you've obviously been successful so far, so congrats.
Thanks.
All right, Brooke.
Hello, I'm Brooke. I live here in Bend, and I am a investor. I wouldn't say super experienced by any means, but doing it for about 9 years. I have my husband and I have 3 properties, a 4-plex and 2 single-family homes, and I manage those and would love to continue to expand our portfolio. I don't have a vision board, but I would copy and paste everything that's been shared so far. I think 1 more door this year would be rad, next year too. So it's my goal, is continue to find ways to continue to purchase things at cash flow. So no experience in commercial, but definitely want to learn.
I know. So do we. All right, Eric.
Hey everybody, my name's Eric. I own short-term rentals and property manage for some family members' long-term rentals as well. I have a duplex here in Portland that I'm house hacking and Airbnb the other side. And I had the pleasure of meeting Suzanne and Sarah, who represented me on my most recent purchase down in La Pine, just south of Sun River. We just did a full short-term rental down there as well. So yeah, right now just those units in Portland, Central Oregon. But my 9 to 5, I also work in sales at Vacasa. So I kind of dove into the vacation rental industry, learned tons of data for analyzing, and would love to expand that portfolio. But I've made some great connections through there for, owners who are ready to retire and exit their portfolios. And some of those opportunities are commercial. Would love to just kind of learn more about how to manage, how to structure that, and potentially dive into something new come next year. So I don't have a vision board yet. Sorry, I missed that train, but I would say, yeah, for next year, I would love to do my first multifamily proper deal, do probably a new build fourplex, and would love to do a commercial deal as well. So excited to learn.
Nice. I love it. Those are all aspirational and exciting goals to diversify into different areas of real estate. Excellent. Well, I'll just give you my quick background. I think most of you know I was in the corporate world for most of my career, working at Adidas and Teva, the sandal company, for a decade and a half. And early on in my career, I read the 4-Hour Workweek and realized I didn't want to work for the man for the rest of my career. So realized that one way to create passive income is to invest in real estate. So we bought our first duplex when we were still renters in Portland. My husband's a contractor, so fixed it up, and we got everything ready to go and rented before our first mortgage payment was due. And then by the time the second one was rented, we had passive income, and I was so excited that I was like, I'm going to help other people do this. I'm going to get my real estate license in addition to still doing my corporate job. So I actually had my corporate job until this time last year. So I've been triple dipping, I've got the real estate investing biz, the real estate sales biz, and then I had corporate for a long time, but it helped me build up my portfolio, and the W-2 is a great way to do it. So Eric, you're doing the right thing by keeping the W-2 and leveraging what you can out of that. So we just kept buying, and then we got single and multifamily properties. Then we house hacked. I'm actually going to be spending Thanksgiving in my house hack in my little apartment in Portland underneath a family of 6. So that's always fun and loud and exciting. And because people were paying our mortgage for those 3 years, we were able to invest more down here with the ultimate goal of moving here. We thought we would have to wait to retire, but we didn't. And then I just shifted my business here, started the Central Oregon Investor Network as a way to connect with all of you, and just love working with investors. That's my thing. I learn something every time, and I hope that I can share what I learn, and I love bringing in new folks for us to learn from. So let's hear about Bob Thomas.
Hey guys,
I know.
I'm
Look
gonna
at
I hope y'all can hear me. Bob Thomas. I just moved to Bend from Portland about 6 months ago in May, maybe a little bit less. I run a real estate investment company, primarily based in Portland. We've had assets throughout the West Coast. Focused primarily on value add, mid-sized multifamily and retail, though we're pretty much asset class agnostic. We just like finding good deals, and we feel pretty comfortable being able to execute regardless of asset class. My background is in corporate finance and accounting. I have a CPA background, worked in public accounting out of school, mergers and acquisitions, and then kind of transferred into institutional commercial real estate in San Francisco. So I was working at CBRE, selling large office buildings for institutional clients, Blackstone, large, pension funds, hedge funds, sovereigns, things like that. So that's where I cut my teeth in real estate, kind of on the commercial side. And in 2017, moved to Portland. Wanted to try it on my own. There's kind of a story behind that of kind of switching from brokerage to the principal side, but wanted to kind of start on my own. So just started networking my tail off in Portland. Met a bunch of different investors and was doing a little hard money lending at the same time. So you can kind of give money to people, see the financial people doing deals, who you should partner with, kind of have a non-competitive relationship with a bunch of different people in the industry, and started syndicating some deals, and have just kind of built up peak since then. So we're an integrated investment firm. We're kind of like the quarterback of the deal. So we'll do acquisitions, we raise money for the deal, and then we'll operate it, project management, construction management. We have a property management company in-house. And yeah, so we're pretty small right now on the grand scheme of things. Our portfolio is like $50 million, looking to hit about $1 billion in the next 3 years. And that goal is just to become institutionally investable. And when you hit about $1 billion, you can start going to the pension funds of the world and having them invest in you. So that's kind of our midterm target. But yeah, that's me. My vision board was, I didn't do a vision board. I was sitting in there typing on my computer, but I was doing my corporate strategic plan for 2024. So our vision board was 75 million in new acquisitions. There was something on the HR perspective, and we were going to start an internship program, which I've actually already gotten going with.
Oh, nice.
4 different schools. So yeah.
Sweet. That's exciting. Excellent. Well,
and one other thing is I've been told time and again, and I was talking to Suzanne, she said the same thing. 1, I talk too fast, and 2, I use a shitload of acronyms and things that people usually don't know, and I just don't know when I'm making an acronym and not. So if I say anything that someone doesn't understand, it is okay, just stop me and be like, what did you say? And I will take a step back and explain it.
And we can always re-listen to the recording.
But still, if I say something that's an acronym, you'll have to Google it.
Perfect. All right, we'll make sure to stop you. Okay, we'll learn more about you as well as we go through. But we had someone else join. Oh, and they're already gone. Okay. Well, if they pop back in, we can go through. But we will just cruise along. Okay, so we're just going to start with a simple definition of what commercial real estate is. And, well, do you want to talk about this?
Sure.
Okay.
So real estate, right, it's very broad. And I mean, there are, within real estate, you can have, you think of a house, right? That's the first thing you think of, a house. And then some people are like, oh, a duplex or whatever. But if you think real estate, you can also think land. Right, developable land. Then you can think, how is that zoned? Well, not all of it's just zoned for houses. Some can be zoned for kind of a lot of different commercial purposes, office buildings, retail buildings, hotels, etc. But on top of that, you can real estate are any sort of title income on land. So you can sell an easement, and that's part of real estate. You can have a ground lease, like a 30-year lease on a piece of land. That's real estate. And so basically, when you think of what is commercial real estate, it's almost like what is not. You think residential is not, and probably land is not, but everything else that's used for a commercial purpose is. And so it's a very broad, it's very asset class rich within this commercial real estate that people kind of talk about.
Yeah, and then from a financing perspective, anything that's 5 units and above is considered commercial. So if you're buying a 10-plex or a 50-plex, like Bob's under contract on, then that is considered commercial. But anything from 1 to 4 units is still residential from a lending perspective. Okay.
The only nuance there would be if it was a 1 to 4 unit property in a commercially zoned area used as a short-term rental, that can qualify as like a hotel.
Oh, okay.
Which is kind of a weird nuance, but I've seen that done.
Okay.
Yeah.
So maybe that could help you get around some STR regulations?
Oh, definitely on STR, but on financing too.
Okay. There we go. Some ways to get around. This is what we like.
Almost need to do that in Bend.
Yeah. We gotta find these places.
Yeah, if you get, like, I have a friend who he has commercially zoned land in basically right across the river from here. And yeah, you're totally excluded, I think, from not the occupancy taxes, but at least from all the short-term rental permits. You're just a hotel.
Yeah. And there are even some residential homes within Bend on certain streets that I can tell you, if you ask me, that are zoned commercial. They're single family homes, they're zoned commercial. You can operate an STR in those places. So we keep our eyes on those spots. Okay, so why would somebody want to invest in commercial real estate instead of or in addition to residential?
Yeah, so we chatted about this a little bit before, but I think that if you go back to my answer to the last question, what is real estate, right? And we say, what is commercial real estate? There's so much within there that, you know, if you say, I'm a residential investor, like you're tying yourself to one very specific demand driver, economic driver of like housing, where that can be really good in some scenarios, but you're missing out on a lot of other, you know, potential economic drivers and upside factors and just different things like that you're just totally excluding yourself from by not looking at commercial real estate. So it's interesting with like short-term rentals, you know, that has the occupancy side and you know, kind of housing aspect. But I mean, that's basically like a hotel. And so that's part of commercial real estate. But, you know, retail, industrial, office, data centers. I mean, data centers in industrial are huge right now with e-commerce and Amazon and, you know, kind of everything that's going on with AI and whatnot. I mean, how big is that that data center out in Prineville?
Facebook.
Yeah, the Facebook one.
Huge, yeah.
It's massive.
Yeah.
I was flying back and met a guy who was doing a project management out there. And I mean, I used to sell data centers when I was at CBRE. The numbers on those are insane. So, but if you think what you're able to invest in, like the real estate behind tech, if you're doing data centers or something else, instead of just housing. And so it gives you a lot more diversity and kind of flexibility.
And that ability to scale. I think that was the big one that
And-
you talked
yes.
about. Like one deal, you know, one deal that you're working on right now, you just told me is you're going to be all in for 6 million, but it's worth 10 million as stabilized,
Mhm.
right? So that's just one deal, and you're getting multiple units. You're getting more doors under one roof, essentially.
Yeah, I think the people talk about doors, and I really talk about portfolio value because 50 doors in the Midwest is like a fourplex in Seattle. And so, and so, you know, I mean, the yield might be better in the Midwest, but so I don't think doors is a good analogy. But yeah, the ability to scale out on deals and the way my company works, and we'll go into this with financing and everything, is, you know, we're that quarterback. And so we don't put in as much money as everyone else relative to the returns we get. Like if I put in $1 on a deal, I'm expecting like $5 back. Whereas my investor, you know, over a couple of years, whereas my investors might be expecting 50 cents back on their dollar, right? And so when you scale that out, you know, on this deal, like I'm going to put in $500,000, but I'm going to probably make 2 of that 3.5 upside. So, you know, when you scale and you have the promoted interests, you know, from partnerships and structuring, that's where you really, you know, are able to kind of leverage debt and equity to juice your general partner returns.
Got it. More ways to make money. We talked about this as well. So can you explain triple net leases?
Yeah, so with residential leases, I mean, we do a lot of residential leasing. We have a management company and everything else. So, you know, we'll buy properties that just are getting base rent and the landlord is covering the utility fees and, you know, water and sewer. But then sometimes you'll get, you know, RUBS, ratio utility billing, where tenants are paying a little bit of the utilities. Well, in commercial, like there are gross leases where you just pay a base rent, but there's triple net is on the opposite end of that spectrum, where literally it's like a bond. Like you buy a property and the tenant pays for everything. They're paying for property taxes, insurance, maintenance. That's what the nets are: net of property taxes, insurance, and common area maintenance. And so you can have different ways to make money on these leases. Like you can buy a gross lease, and then when it comes up for renewal, convert it to a triple net. And all of a sudden, you just like took your net income, which is all that matters in commercial real estate, is increasing your net income. You just took all those expenses and added them back into your net income, which dramatically changes your ending value. So the different ways to lease it, and then also with the different the different zoning and everything. Like you're able to convert zoning really easy. Aside from commercial zoning, it's not like you can only do retail here or you can only do multifamily here. Just what you were saying with that house, it's commercially zoned, but I can do a hotel, I can do a retail building there, and so you have a lot more flexibility. Where if something's going sideways with some economic driver, we're just going to pivot, re-tenant, retool this into a new space, and you can do that. Whereas you can't do that in residential real estate.
Yeah. So with triple net leases, just to summarize that for folks for whom that is a new term, essentially as the asset owner, your only expense is the ownership of that asset, the debt service. Everything else gets shifted to the tenant, including any tenant improvements. So that would be like this office, you know, when Realty One Group Discovery moved into this office, they had to pay to make this nice conference room and, you know, put in the nice bathroom wallpaper and all the things so that it looks nice and is on brand for this business. When someone else moves in here, they're going to have to redo it at their own cost as well. So just to kind of
that is a negotiable piece. And if a landlord puts it in, they can also basically charge more for rent for that. It's called amortizing the TIs. But yeah, that is really interesting. A perfect example of this is I have a building in Portland. We paid $15,000 for insurance last year. And everyone's been hearing about insurance going crazy. I just got the renewal quote at $43,000. I'm going and shopping it. It's going to be fine. But on a fully triple net deal, who's having a problem with that? Not me, landlord. That's all getting passed through to the tenant, right? And so you're hearing about all this stuff with insurance and everything else. I mean, a lot of the commercial leases are just passing that right on through to the tenants.
Any questions on any of this? Nope. Okay. I'm going to move us along. Okay, we're going to get to question number 1 that Bob hears all the time. And this is probably what some of us are thinking too, right? Most people start in residential real estate. Bob is the exception. He started his career in commercial. So we asked Bob, how do I get into commercial when all I know is residential?
And yeah, I say I'm the worst person to ask that, because when I got into hard money lending and I was starting to work, you know, doing little hard money flip deals for residential, I had no idea like how residential worked. Like, you know, what's a backsplash worth? You know, how is this going to add, you know, a new kitchen going to add a bunch of value? Like, I don't know. If you tell me it's going to increase rent by $500 a month, I can calculate that really easily. So I, you know, after having done this a while, I think the easiest way to get into commercial from someone who doesn't have experience is partnering on deals and not being greedy. So figuring out what your skill set is, what interests you, defining your investment thesis and everything, but like just trying, even if you do it for free, like you need to get experience in this stuff to start out. And so if you do 10% of a really big deal, like that is infinitely better than doing 0% of a really small deal or a really big deal. So any little bit of experience you can get is really helpful. And so finding someone to partner with, whether you were to bring me, you know, a deal, you said, hey, you know, I found this commercial property, I just tied it up. I'd love to wholesale it to you, but instead of the wholesale fee, can I roll that in as equity and, like, you know, work alongside you? I might be very open to that. Or can I help with asset management? Maybe I can help raise money. So you just got to figure out what, you know, if you think about this kind of three-legged stool of acquisitions, kind of asset management, so finding the deal, running the deal, and then capital markets, raising money for the deal. Figure out within that what you could help with, and then find someone to bring that value to. And don't be greedy on the first few deals. Like, just get the damn experience, because then you'll be able to leverage that into larger stuff that you own more of. Another way is to be, you know, financeable right off the bat. So if you can help sign a loan, you know, you can easily get money just for putting a signature on the loan. But like
So someone with a W-2 could be that person for you.
yeah, a W-2. I mean, you've got to, you know, on that multifamily deal, they're looking for an aggregate net worth equivalent to the loan amount, and they need liquidity equal to 10% of the loan amount after all the money's in.
Yeah.
So if you can be a contributing factor to that, and you're willing to take that risk, you know, that's the way to get a slice of the deal. If you want to do that and co-invest and help asset manage, well, then maybe you get 25% of the general partnership because you're doing a lot.
Okay. Any questions on that? No.
Has anyone partnered on a deal before?
I have.
Oh,
Who was that? Was that
Sherry
Sheree?
has. Yeah, Sheree has.
Okay.
Eric, you have to?
Yeah, I partnered with family before, but it's more so like, a word of mouth, like open partnership where I property manage. We split 50-50. I found the deal, and my partner brings, the cash to close.
I mean, that's great. That's like the perfect sweat equity. Do you put in any money?
No startup costs. No, I put in a little bit for furnishing, but mostly it was no money down on my end.
That's how I started. Now when you do it long enough, you start getting the money back in from former deals, and you're like, shit, I have to do something with this money. But yeah, when I started out, it was like pretty cash poor, but I knew I could raise money. I had experience in capital markets. I knew I could find deals. So I just would take, 10 to 25% stakes in these things for putting the deal together. That's a great way to do it. So you just would shift that focus from a residential property to something a little more commercial based.
Yeah. I think also extra, I knew I had a little bankable side of it where I was willing to house hack and live below my means to, reduce our down payment needed. So we did primary residence loans. I was the primary occupant, so we could do 3.5% to 5% down instead of 20% deals. So.
Yeah. Sheree, what kind of partnerships do you have going on?
On the financing part, they come in with the money. I do put down the earnest money. Down payment isn't really an issue in what we do. And rarely is there it depends on who I'm working with. If I'm working with a wholesaler, not partnering with a wholesaler, but buying from them, then they usually have a higher earnest money deposit. So I take that, and then my partner will front the money, and then basically finance it for me.
Got it.
Yeah.
Yeah, that's cool. Yeah, I think the big thing with partnerships is that a lot of people they're scared to do partnerships because they feel like they're giving away too much of the equity, or they've tried a partnership once and gotten kicked in the teeth and think it sucks. Well, like, you're supposed to get kicked in the teeth when you start doing partnerships, because like you need to learn how to structure stuff right, and you're gonna screw it up the first few times. So if you screw it up on like a smaller deal, or you limit your risk on those ones that blow up until you really figure out how to do it, that's the right way. I mean, you want to be looking at getting partners that bolster areas where we are weaker or don't want to be working in that area. And then beyond that, you're aligning incentives so that everyone's pulling in the same direction. They're all incentivized to make money in the same way. And especially if things go sideways, and you don't want people to be incentivized to do two different things when everything's going sideways. That's the time when you need to double down and be like, we got to figure this out because we're both as fucked. If this is going south, we're both screwed. So let's figure it out. And I've been bit multiple times because I didn't have those pieces lined up. And that's really what you're trying to look for in a partnership.
Yeah, those aligned interests, I think, is really important too. Okay, question number 2. How do I pay for this when these deals are $4 million? How does this work?
So I think about it like they call it the capital stack. And so you think about the total cost that you need to do a deal, like a bucket, and then you like fill it up from the bottom up. And so typically your biggest portion of that is going to be like bank debt or first position loans. The amount you can fill that bucket up really varies depending on the asset class. So multifamily, 5+ multi, especially multi over like $1 million loan size, and especially multi over like a $7.5 million loan size. There's very programmatic, like government funded kind of ways to do that. So you hear Fannie and Freddie, and you think of that for like single family purchases. Fannie and Freddie, the agencies, have a huge component of multifamily lending. I have a bunch of loans with Fannie and Freddie. So they're very programmatic. It's less onerous than getting a single family loan in terms of like these little DTI checks and everything, but it's very programmatic about debt service coverage, how they price it, how they size it and structure it, and everything else. And so when I'm buying a multifamily deal, I'm usually buying something very value add, like I'm adding a ton of value. They don't finance that. They only finance the stabilized properties, but I'm able to underwrite a refinance based on agency underwriting. And so I know very clearly if I do X, Y, and Z to the property and push rents from here to here, and fix these 5 things, here's what my loan's going to be, dependent on interest rate. So
Sorry, just to stop you. Does that mean when you're first buying a property that's not stabilized, you cannot use the Fannie and Freddie loan?
it's very difficult because they have a lot of checkbox kind of things.
Okay.
And so when you're buying an unstabilized multifamily property, it depends on how unstabilized. But you can go get a hard money loan, right? I mean, I'm kind of getting a quasi hard money loan on this. Higher leverage, higher cost. They'll finance rehab in. On a 30-plex I bought a couple of years ago, we used a local credit union, and they funded 75% of the purchase price, and then we funded the rehab out of equity. So we raised more money. It diluted the equity yields a little bit, but now I'm sitting on a 7-year 3.3% loan that's, I don't know, cash flowing like a 15% yield. Like, it's a great deal. So you can either basically with multifamily, 75 to 80% of purchase price is generally achievable, except in this market, just because of debt service coverage. But that's kind of the LTV parameters you're looking at. When you go outside of multifamily, then you're looking more like 65, 70, like capping out at 75 for a stabilized kind of deal. Again, that's more like bank lending and everything else. But so if you're filling your bucket up somewhere between 65, 75 of the cost, you've got to figure out 25 to 35% of that as like true equity that you need to raise exclusive of a loan. And so that's kind of what I end up looking for is, all right, beyond that, do we syndicate the money? Do we raise it from a bunch of high net worth people? Do I do a joint venture? Am I able to fund it all myself? It's very deal dependent, and how much leverage you can get from the lender, leaves you with how much equity you need to kind of finish it off.
And the loans that you're getting for commercial properties do not rely on your own individual income, correct? It's all based on what the asset can produce, or no?
It really depends on lender, loan size, like a few different things. So if you're getting a loan from a bank, the worst place in the world to be like playing in terms of the debt is what I'm playing in. It's this $1 to $5 million bank loan space, because they underwrite the property, they underwrite you, they want it personally guaranteed, and they look at, like, they have loan steps and loan stipulations in there where the property can't drop below a 1.2 debt service coverage. You globally can't drop below a 1.2 debt service coverage. If you have multiple loans with them, they have cross default provisions. So if one loan defaults, they all go into default. So, and it's personally guaranteed. So it's a weird space to play, but like you get real terms out of it beyond that. When you start scaling up past that, or you go into agency loans and everything else, it becomes a lot of it's non-recourse just right off the bat. So the lender only has recourse to the property. They still look at you personally just to see that the boxes are checked and they're not getting in bed with someone weird. But like in actuality, if everything goes sideways, they don't come after you. They just come after the property. So you do need to look good. Like they always have to be that you've got 10% of the loan amount in liquidity, that you've got a net worth, greater than the loan amount, things like that. But like you want non-recourse at the end of the day. So if the deal goes south, your whole, asset pool isn't at risk.
Got it. Okay. Questions?
So, yes, Bob, so I'm trying to also understand what your business is. Are you part of the financing projects, or do you help find financing?
Yes. So what we're talking about right now is general commercial investing, right? And so the company I'm most passionate about is that kind of investment company. I also work with a hard money lending company. We sold the KKR, so I still work with the company, but we ended up selling to a large private equity shop. We do like $1.5 billion a year in hard money loans, so single family fix and flip, ground up construction, commercial bridge debt, and like true commercial, bridge stuff on like the non-multifamily side. So the answer is yes, I do both. I think right now we're talking more about the commercial stuff than like.
Right. Sorry, the connection is kind of going in and out, so I'm trying to hear everything. And you are in Bend, yeah?
I just moved here in May from Portland.
Yeah, okay. All right. Well, I'll need to connect with you once I get one.
I'm gonna put it in here.
Great.
As at
Peak asset,
mgt.com. Okay, there's Bob's contact info in the chat. So you can connect with him. Okay. All right. Oh yeah, let's talk about seller financing and commercial.
So seller financing is another great option. We'll kind of run through this one. It's a great, like seller financing is a great option if you can get it in any scenario. I think what you're looking for is the right kind of seller, right? You need a person who doesn't need the cash, maybe has the tax impact that they want to avoid and everything else. So I've been able to find those kind of sellers who are either like owner-occupied businesses, so that the real estate is owner-occupied by the business that the owner does both. They usually don't care as much about the real estate, are more focused on the business, and are willing to. They already know about seller carries because a lot of small businesses sell on installment sales. So it's a really easy pitch for that. And then just non-institutionally owned commercial real estate. So it's just an individual, a married couple who own like a $6 million piece of property. That's a lot easier to sell than, buying from an institution that has a bunch of investors that have 5-year, return targets and need to get the cash back because they don't have the same incentives. So the seller carry is a great option. I did a deal at 17 correct over retail in Portland. We got an 80% LTV loan at a 4.25 interest rate, interest only, for a 5-year term, non-recourse.
Wow.
And the seller for business space in the ground floor. She's paying me $15,000 a month in rent, and I'm paying her $8,300 a month in mortgage.
Wow.
And that's just her space. Then I've got 17 apartments and another cafe that's paying me rent too. It's a crazy deal, but I'm just saying, so seller carry can be phenomenal.
Yeah, Eric.
Yeah, sorry, Bob. I just had a question on that. I have a few potential seller finance commercial deals that I've been chatting through, but I'm curious. It's all flexible, right? And that's the huge benefit of a seller financing option. You just mentioned with that specific loan, it's a 5-year term, and so that brings me to the question of, I understand a lot of commercial financing and deals like that might be shorter term lengths with balloon payments or this or that. So can you speak a little bit to your financing strategy? Is your strategy there on that to just improve the value, refinance to conventional financing or some other way after the 5 years? Like, how do you work that out?
Yeah, so and we'll get into this if we have time in the commercial financing space. But yes, almost all of your commercial loans are on 3, 5, 7, 10-year terms, never fully amortizing almost. And so you're always left with a big balloon payment. I only do value add deals. And so on that deal specifically, I mean, we bought it for like $2.9 million. I think as is, it's probably worth $5 million, and as stabilized, it's probably worth 6.5 or 7. And so I don't have any issue going to refinance that. And we evicted all 17 of the tenants upstairs early this year. We'll be done with the rehab and all of those in a week, and we'll be leased up in the next 2 months, 3 months. So that deal, I'll be able to get bank debt if needed. I'm really gonna try to see if I can push her to extend out the loan because it's such a sweetheart deal. But yeah, like with that, I think my biggest play will be almost if I can keep the loan in place. Like I'm gonna have 3.5 years left on the term. I want to keep that in place as long as possible. I may get a commercial second to be able to suck some of that equity out to go redeploy in the meantime. Because whenever I have too much cash flow on a property, like it pisses me off because that means I have way too much equity that I'm not using somewhere else. So, but yeah, like this is where the office market right now is screwed. Because everyone got into these 5, 7, 10-year balloons, and they all were sized at 65 LTV, but now the market is 25 to 30 cents on the dollar. So the lenders are screwed. Like people are kicking back the cash, and the lenders are taking 50% haircuts on their loans. So you definitely are burning fire unless you are really confident in your exit strategy and you're able to really boost value over the long term or have a low enough, LTV going in.
Okay. So you're basically saying with your value add play, you're never worried about said balloon payment because the value will always be increased based on buying the right deal. Is there then, so when you're setting your, your long-term financing in play, is there a long-term loan product when you are refinancing, or are you going private money on that? Does it depend on the deal?
I'm usually going to banks for long-term financing, and a lot of banks will do amortize, they'll amortize for 5 years, but it'll be a 10-year term. And so there will be like some bleed down in the loan over time. But also when you're at a 10-year loan, like you've got a ton of horizon. I mean, if you just think about inflationary growth on rents and everything else, 10-year loan with 2%, 2.5% annual growth, that's a 25% increase in value right there just through inflation. So fixed rate debt and term, usually things work itself out. Every once in a while you get bit, but again, that's why like you make sure you size risk and kind of stay on top of your balance sheet.
Cool. Thank you.
Okay, I'm gonna move us along. Okay, next question. Where do you find deals?
Everywhere. Absolutely. But I think the same is true in resi. Like you just need to have as many lines in the friggin' river as you can in order to catch a fish that you're looking for on this side. So like broker relationships, wholesaler relationships. If you can do an off-market deal finding campaign, you should do it. But like I find so many of my deals either from brokers that are coming like pre-market, so they hear about a deal, they bring it to me first because they know I buy stuff, or like a deal that was on the market that then came off, and I'll like reach out to the seller directly. But like the answer is yes. Like you just need your phone to be ringing with deals, and from every source you can. And so websites are CoStar, LoopNet, Crexy. I think those are great places to get started, but you should use those to see what brokers are out there, and then start calling those brokers, having lunch with them, making sure that they know your name and they know, and it being regular about that. Like people have CRMs and stuff for their off-market deal finding. Like you should have a CRM for commercial real estate brokers. And when was the last time I called this guy? Like when, what's his wife's name? What's his kid's birthday? Right? I mean, you should have that level of knowledge, because then you know that they will have that level of knowledge about you. And when they find a deal, you're going to be first to mind.
We're just getting some social content.
Cool.
Don't worry.
So yeah, that's my everything all the time. Yeah, every way you can.
All right. So what's a good deal, Bob? How do you know a good deal when you find one?
You need an investment thesis, and it really depends on like where your money's coming from and what you are trying to do. So if you've got a ton of money and you're trying, you're over allocated into equities, you're worth $10 million, and your 60% equities and 40% bonds and no real estate. It's like you're probably fine, and you just need to like take a little bit of that and go 30 on real estate, stocks and bonds or something. In that case, maybe you just buy a triple net lease retail building that's going to get some cash flow and be in real estate and not worry about it. For us, because of how we capitalize stuff and what we look at, like we have a very tight thesis of we want to be in markets that are experiencing above inflationary growth. We want to find value add deals in those markets to force appreciation to the point where we can refinance out all the capital we put in. And then we want to spin that wheel as fast as we can and increase our velocity of equity. So we want to buy a deal in a really good market that over time is going to grow past inflation. We value add it, pull our money out and do it again and hold the asset. And then the asset's going to experience above inflationary growth into perpetuity. And that's the secret in my mind to creating wealth. So that's how we do it, but everyone's got their own thesis, and you need to really figure out, location where you want to be, asset class, what you want to be in and why, and then you just go do it.
Yeah, and do you want to do value add or?
Yeah, value add or stabilized, there's a bunch of different options there, but it's really about creating a thesis.
And that's how you're going to know a good deal when you find one.
Because
You
it
gotta
fits into
know
your
what
box,
you're
your buy
looking
box.
for. Yeah, exactly.
And people ask me, what's your buy box? And I'm literally like, I underwrite to a cash out refi in 2 years. And they're like, what does that mean? I'm like, I will buy anything if you can like give me sober underwriting assumptions that prove I can get my cash out in 2 years and it's an allocation I like. And that's my buy box.
Clear. So this is the answer where it depends on what you're looking for, but if you know what you're looking for, it's easier to find deals. Okay, this was a good tip that you gave.
So yes, to get to people say, where do I start? How do I learn? about, different types of real estate, and how do I know what the inputs are to see if it's a good deal or not? And like the work has already been done for you. Like it is spewed across this thing, like spewed across the internet. Like go to any of those main websites or the brokerage websites and find a hotel, like a hotel offering memorandum or an industrial offering memorandum or any asset class you want. Find like 6 of them, and then look at their market analysis and their financial analysis of the property, and it will literally tell you what the inputs are into these deals. And so like you can pretty quickly go through and say, oh, well, I think hotels are cool. I'm going to go and pick a few different hotels and like see how they analyze these things, and you'll understand the inputs that go into them. So that's the easiest way to cut through all the bullshit and really get to like, here's what goes into what a good deal is for this specific asset type. Like office, it's going to be tenant migration trends. How many businesses are coming to an area? What's been the net absorption over the last little bit, and what's the forecasted net absorption of square footage of leasing? What's leasing velocity? Self-storage is going to be like in a X mile radius around your property. What's the median income, right? Is it over $115,000? Like there's different things like that, but you'll see that in those offer memoranda. So you'll be able to take a look just by doing that.
Okay. ROI. Okay, what can someone expect to get out of commercial real estate?
It depends on how you're doing it. If you're doing it like I'm doing it, where I'm the quarterback of the deal, then I'm looking for 3 to 10x on my equity in a couple of years. But that's because I'm putting in very little amount of the capital to how much of the deal I own, because I'm basically doing sweat equity, kind of like what Eric does. If you're just a passive investor, depending on the risk profile of the deal, like a value add deal, you should be looking high teens to mid 20s of an annual return over the life of that. And about a third of that should come from cash flow from the deal, and about 2/3 of that should come from the back end sale or refinance or whatever. So, not everyone is going to have the stomach to set up a big company and take, personally guaranteed loans and stuff like that. So the 3 to 10x is difficult to achieve, but it's achievable. The 15 to 20 IRR is pretty straightforward.
So that would be somebody just investing into a larger.
Yeah, like if someone's putting money into my syndication on the 50plex, like they're gonna get like probably a low 20s IRR on the deal.
Got it. Okay, let's talk. This is an important one, the state of the market, because there are 3 essential asset classes that we're going to talk about and where they stand with current events.
So interest rates are obviously screwing everyone up. Everyone knows it. I think if you look at where the market is and what's really going on, you can kind of bifurcate it almost by the debt that they're on properties. And this goes back to our conversation, Eric, from a little bit ago. So with residential properties, you've got 30-year fixed rate mortgages that pretty much make up all loans on resi. And so I'd say that's one bucket, because no one's getting affected by, I need to sell my property now or else I'm getting foreclosed on, right? At least because it's coming due. Like if you're not paying, that's a different story. With commercial though, everything's on 3, 5, 7, 10-year terms. So people who bought properties 2018, 2020, that stuff's starting to come due, and it's all coming due with large balloon payments. Well, with where interest rates have gone, they might say they can do a 75% LTV loan, but they also throw that stipulation, well, we need to be at a 1.25 debt service cover. So your property needs to generate income that covers 125% of your loan payment. Well, with where interest rates have gone, that math doesn't work. You're talking like 50% LTV. So these people who were in at a 75 LTV now have to refinance at a 50, and they don't have the money to bring in 25% to buy that stuff. It's more than like the down payment, or as much as the down payment they put on it. So those people are forced sellers right now, and that's with every commercial asset class when the debt's coming due. And so that's kind of what you're seeing in the market, is this like, until interest rates really normalize, and I mean we've seen 50 bips come off the 10-year in the last week, but I think it's gonna be about 18 months until something breaks and rates come back down, like materially. That's for every commercial asset class. And then you've got office, which is its own animal because of what happened with COVID and work from home.
banker's office. Hang on. I have a slide for this.
And so that is its own total beast, because not only are you dealing with that BS around rates and debt service coverage and everything, but you've also had a structural change in demand where people are no longer wanting as much office space. And so where people used to underwrite 8 to 10% vacancy rates on office, they're now looking at like 50% vacancy rates. So that just naturally lops off 40% of the value of your property. And then you have the debt service stuff on top of that. So you're seeing office trade at like 30 cents on the dollar right now. I was telling my son Suzanne about a deal my buddy bought in Chicago for $43 million. It last traded for 110 million in 2014. It last got a loan for 86 million in 2019, and it just sold for $43 million. And so it's like those are the kind of numbers we're talking about. So office is its own like crazy shit show. And I think we've got a 3 to 5 year horizon before anything materializes out of that. And it's going to be when all the office product starts to get like repurposed into residential, data center, something else for like the 1980s, 2000 vintage properties. Because right now there's an oversupply relative to demand and there's no end in sight. So residential, I think, has the biggest floor under it, where because people aren't forced sellers, it's fine. Other commercial, you've got about 18 months of really good buying opportunities, and I'm licking my chops to take advantage of that. And then office, you can buy great deals right now from a basis perspective, but you don't know what the hell you're going to do with them. And at some point, people are going to make a lot of money because they bought that stuff. But if you buy it with debt and you got to pay a lender without cash flow, they got the scary proposition.
Yeah. Eric, what you got?
Yeah, no, I mean, Bob, you kind of spoke to most of my question of like, I mean, on the residential side, you listen to the people who are smarter than you, and it's like when there's blood in the water, that's where the best opportunity is. But would you say the problem in the office space where they're struggling is that I would make the assumption that you're limited by zoning designation, right? You can't just go and buy the office spaces and convert them right away. Is it the limitations of maybe the city or the county loosening those and allowing them to be converted before you can actually do so? That's kind of causing that opportunity to be, like you mentioned, 3 to 5 years out.
Yeah, to some extent. I think that like the trades aren't unwinding yet. Not everyone's loan has come due yet. And so like, and there's just such a supply glut where you're starting to see some residential conversions happen, but like it's not as much about the zoning. It's really challenging. There's architects who did a study that like the best offices to do resi conversion, it's side core, so elevators on the side, not a center floor in the middle. And then, kind of long, skinny, like 40, 50 foot wide, whatever long. So you have every unit has like natural light without buried bedrooms. Like, so it's just, they're structurally kind of obsolete buildings. And so figuring out what to do with those is just going to take time. And what you're seeing a lot of is this flight to quality, where tenants in 1980s Class B office buildings are now able to get comparable rents on Class A stuff that was built 3 years ago. So everyone's just leaving these like real kind of Class B product and going to the Class A stuff. So yeah, Class A rents are going to get hit a little bit, but I think where you're going to see a lot of the glut is in this just like obsolete, shit 1980s to 2000 vintage product. And like you can't, it's really expensive to do anything with it. And so you need to buy it at the right price. You need to buy it at like $70 a foot, because you got to put like $300 a foot to do anything with it. So it's just, it's just going to take time for that to unwind. Less about zoning, just more about like when people sell and how much it friggin' costs.
Got it.
Yeah, that's an important one, the state of the market. How long to hold? I think this is sort of it depends.
It totally. So like our thesis is we buy in a market where we want to hold forever. And if you look at what, the wealthy in the country do, like that's what they do. They buy real estate and they sit on it. And if they do sell, they're 1031 exchanging, right? Because they don't need the cash. They're just like trying to figure out how to allocate capital. But a lot of times they'll just take debt out on their asset to go buy another asset and they'll let everything, inflate. I mean, what is inflation? It's the Fed devaluing the dollar. And so if you get into fixed rate debt over time, like naturally, you're just like the Fed is making that worth less every year. And so you just let that happen over time. And so that's my strategy is we buy in markets that are going to rise in excessive inflation. We let inflation eat away at our kind of underlying, and then you can refi and do it again. But you can flip commercial properties, right? I mean, that's just easy. I accidentally did one of those earlier this year. I'm like 1031 because I'm able to, but it was an 11-month, made like better part of $1 million in 11 months. And I'm like, shit, I gotta find a replacement property now. So you can flip it, and you can do long-term stuff too, but it's all about, what your investment thesis is in that project.
I know we're at 1 o'clock. Sheree and Eric and Summer, you have a few more minutes to hang? Okay. So let's talk about the 1031 within commercial real estate, just to clarify for people. So if someone is going to sell a residential asset that they own, can they get into commercial?
Yeah. So 1031s are for any type of real estate. And what I said earlier about, an easement is like, so I just sold an easement right to a cell phone tower that I own. I had a retail building with a cell phone tower leased to AT&T and Verizon. I just sold that, and we're on 1031ing out of that. So that's, you can have, they were in and out of easement rights, ground leases, land, commercial, residential, whatever. So if you're selling a piece of residential property and you have a capital gain attached to it, you can 1031 exchange into commercial real estate. A lot of times commercial real estate is larger than the amount of your 1031. So you'll either have to pony up additional cash, or you can come in as like a syndicate, as like a partner on a deal. There's kind of technical ways to do that, but you have to do it as a tenant in common, or come in like a Delaware statutory trust structure. Or if you are going to blow your window and you don't want to pay the taxes, you can do what's called a deferred sale trust, which would basically you sell or carry to a third-party trust that you control, and then you're able to direct those proceeds out. So the answer is yes, you can exchange in and out. There's creative ways to do it, but it's nuanced.
Okay, 1031 has a lot of details, but I just want to clarify that you can go from residential or land into commercial. Okay, let's talk about risk in commercial.
I think real estate on its own, and Eric, like your point earlier is just so valid. Real estate on its own is like a risk-free asset. It is really hard to fuck up unlevered real estate. Where the risk comes in is putting debt on these things. And where the juice comes in is putting debt on these things. So like managing your debt and your maturities and everything like that is really managing all the risk in real estate. So like, yes, you need to go and make sure that, your assumptions that you're looking at in your deals are valid, and that you're not just doing like a point estimate, that you're actually looking at like, what if it goes down? What if it goes up, right? Sensitizing things. Because it's like doing a budget for yourself financially. The only thing you know when you do a budget is that it's going to be wrong. It's never going to be dollar for dollar exactly what you put. And so you need to say, all right, in a worst case scenario, what happens? Now, if it goes to the moon, that's great. But like, you want to feel comfortable somewhere between your baseline and your worst case scenario. Like if that happens, like, should I still do the deal? If that's the case, like I usually go and do it. But again, the real risk on these things is, if I bought an office building in 2019 that I levered highly, like I am just hurting right now because all my money's gone, all my lender's money's gone, right? So it's all about how you capitalized it, and I think that's the biggest thing. And the risks around commercial real estate, like what we talked about, kind of functional obsolescence. So you saw it back in the early 2000s as retail is getting killed because of e-commerce and malls are going vacant, and now it's office spaces. In commercial real estate specific risks, it's like, people say you always need to have a house. Well, you don't always need to have a mall, and you don't always. So being ahead of those trends or understanding when you need to repurpose is kind of a risk there.
Yeah, but like your mechanic shop, like people always have cars and they always break down, so you're kind of, insulated from some of those risks.
But will they always have cars as we go to an inventory
Right,
economy?
and, yeah.
You got to stay
Will
ahead of
you
some
be
of
able to fix an electric car?
Yeah.
Right. Yeah.
that. Or it's not that, but what capital will it take to retool your shop to be able to do that, right?
Exactly.
Just like what capital will it take to retool an office building or something like that mall into a warehouse.
Mhm. Yeah. So we wanted to make sure we cover risks because they are different. somewhat than residential because we know people always need a place to live. So, but people don't always need a physical space to shop or a physical space to work. So just things to think about.
But again, like data centers, like I want to buy a damn data center. There is no, like, data centers and warehouses are two spaces that I'm like actively trying to get into because like e-commerce is going nowhere but up. It's supposed to be at 30 to 35% of our retail sales for the next like 5 years. And like the amount of data that's being pushed through from, you know, cell towers and AI and everything else is like going to these massive warehouses filled with servers. And like there's so much demand for that. And that's not that in my mind that has nowhere to go but up. So, you know, it's a risk, but it's also, if you are forward thinking, you can get ahead of trends and really benefit from it.
Okay, let's talk about the locations that you are looking at for your investments.
So I am not a cash flow market investor. People think about, you know, center of the country cash flow, size of the country, tight cap rates. That's not 100% true, but you know, relatively speaking, that's true. The way I do real estate is I do value add real estate. So I put in capital to increase income. And if you think about how a cap rate works, like on the coast, say a cap rate's 5, and in the middle of the country, say a cap rate's 10. Well, for every dollar of income that I can increase a property on the coast, I'm getting a 20x return. I'm getting $20 of value for every dollar I increase. In the middle of the country, it's a 10 cap. I only get for every dollar, I only get 10 of value for every dollar of income. So I like those compressed cap rate markets and doing value add projects in there because I get a lot more bang for my capital buck. In terms of actual locations, like I'm very heavy into Portland, just because I was living there and it's been a fine market. I like Charlotte from some of the economic stuff that I've been looking at. Denver, Salt Lake, DFW, Austin are some of the markets that I'm looking at. But really, it's like I look at the macro picture of population trends, median income trends, things like that to build my thesis. If you can't tell already, like I'm the biggest numbers guy. Like I just live in, like I do what my spreadsheet tells me. And so I get as much data as I can, I analyze it, and then I just say, okay, let's do it. And what you're seeing here is what my spreadsheet told me.
I like it. So we're getting to the last question. I have one question, which is, can you give us 2 good news sources to like read up on, stay current on trends in the commercial real estate space?
Globe Street.
Globe
Street. They do a free newsletter. I get that every day.
Okay.
Oh man, I get a few different newsletters. CoStar has a good one if you're a CoStar subscriber.
But you have to be a
I
subscriber.
don't know if you have to be a subscriber. I would look at CoStar because they do good ones. Start with Globe Street. They have a lot of different like sub newsletters. You can get like office specific or multi-specific. And so you can get a bunch of different ones and you'll be driven to different things from there. Green Street's another one, but you need to pay for some of that. So yeah, Globe Street's a great one. I would recommend subscribing. You won't, it's just one delete a day if you know you don't want to read it. It's not a big deal.
Other questions? Yeah, Eric.
Yeah, so I'm curious. I mean, in all of the investing real estate world, like it comes down to popularity, right? Like you buy a place that's popular, you feel confident knowing that somebody's going to want it and it's in demand. So you mentioned, your buy box with criteria of types of things that are going to be scaling up in popularity, data centers and so forth. Can you talk to marketing? Like, how are you putting yourself in front to find potential tenants to feel confident that it's a good deal? Is it just making listings on LoopNet, or how do you run the marketing side of it once you do your improvements and value add?
Yeah, so it depends on the scale, but like we do a lot of our retail, like smaller retail stuff, call it sub 2,500 square foot retail. We'll do that on CoStar and LoopNet ourselves. Anything larger than that though, or if we're not having traction after about 3 months, we hire a broker. And I mean, there's a whole, like as you start scaling up into the commercial real estate world, there are tenant representation brokers, there are landlord representation brokers, there are, investment sales brokers. Like I had a buddy when I was at CBRE, and he made $10 million on one Google lease that he signed. It was 250,000 feet for 10 years at $80 starting rent. But like he made $10 million on one deal. So when you start getting in large enough deals, there are brokers who specialize in that will go for it. So I just leased up a retail building. That was my accidental flip in Portland. We leased up a 12,000 foot retail building. I paid the broker $100,000 in commission, put another $100,000 into tenant improvements, and made $1 million in 11 months. Like it was a fine deal. And so, you're willing, that's just in their capital cost. It's like if you're remodeling an apartment and you have like your kitchen expense in commercial world, it's like TIs and LCs, tenant improvements and leasing commissions are just the capital cost.
Yeah. And if you're thinking smaller scale, like, chop a zero off of those things, right? Like, 10,000 in to make 100,000, or, just to kind of.
But at some point, like we do the 2,500 foot and less ourselves because brokers are like, I'm gonna make $6,000. Like I don't want to put in the effort to do that, and so we end up doing those ourselves. But when you scale large enough, that there are professionals that will do that for you. Like I have my real estate broker's license, but I still pay brokers to sell properties for me because I don't enjoy selling properties. I feel like it's a job. Like what really gets me going is buying shit. Like I love like buying a deal, figuring out the seller's motivation, like figuring out how to get the best deal possible, structuring that. Like that's what, and then I get the buyer commission that I roll into equity on a deal. Like that's where, if I bought right, I don't care about paying someone 2 or 3% to sell it for me because like I made all my money on the buy. So leasing brokers happily pay you. Listing brokers happily pay you.
Gotcha. And on the smaller stuff that you said you make listings for yourself, like, would you say it would be educational enough to just dive into LoopNet, CoStar, and learn in order to find comps for how you should price your leases on the smaller stuff? Is that sufficient enough, or would you still partner with a broker to be priced right for that?
I'm pretty confident when I get into a deal that I know what the market is. And now we have enough like small scale retail where I can say in Portland that like between 175 and 225 a foot, depending on 250 a foot net, depending on location, like that's what it is. But yeah, LoopNet should give you a really good indication of general market stuff. CoStar will give you actual closed comps. And then if you have friends with brokers, if you're friends, you can just call them and say, hey, like I'm looking at the property. It's like I'm generally underwriting this. What do you think? And they'll, rationalize it if needed.
Cool.
But again, that gets into like you should have a CRM of brokers, and you should literally be hitting them up all the time. Programmatic broker outreach. That's like one of our mainstays in our acquisitions department in our company.
Because they'll bring you the best deal.
Yeah, because you are literally top of mind. If you're like one of their top 15 phone calls, like all the time, like they're just going to call you when they have a deal. Mm-hmm. And they're willing to answer questions for free about lease rates and shit like that.
Nice. Other questions?
No,
Okay.
that's great.
Bob's contact info.
Great content. Thank you.
Yeah. And if anyone wants the recording to review later, let me know. Hit me up and I'll happily send it out. And I appreciate you all being here. Cool. Thank you.
Thanks, Bob.
Yeah. Eric, I'm gonna be in Portland tonight at the Asian Real Estate Investors Association. It's in Beaverton at the Lifetime. It's from like 6 until 9. There's a few different people there. So if you're interested, there's gonna be a bunch of different investors and stuff. But if you're free, you should go.
Yeah. I'll definitely be there if I can fit it in tonight. I think I've seen you in some of the local groups here. So if not that one, yeah, I'd love to meet up in person.
Win.
Sweet. All right. Thank you guys. We'll see you next time.
Thanks, guys.
Thanks. Bye.